Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. We have a new guest on today. His name is Axel Merk. He is with the founder and also the portfolio manager for the Merk investment funds out in California. Axel Merk, thank you so much for joining us today.
Great to be with you.
Well, back in April, and I'm not trying to throw dirt on you here, but back in April, a lot of people were saying the dollar was weak and things were going bad for the dollar, and yet it's gone crazy in the last few months. It's gone straight up. It's over 84.6 on the U.S. dollar index. What's going on with the dollar? Why is everybody clamoring to get their hands on dollars with all this money printing?
Well, sure, there's this old saying that markets can stay irrational longer than you can stay solvent. What's been happening is everybody is factoring in this Fed exit, the tapering you've heard so much about, that everything is going so great in the U.S., everything is so horrible in Europe. And, of course, as long as that story is the prevailing story in the markets, the dollar is getting some tailwinds. Having said that, we don't think everything is just so great in the U.S., and we don't think everything is just so horrible in Europe. And importantly, if you think about everything is going great in the U.S., that's actually the biggest threat we might be facing right now. Because if everything goes great, well, interest rates are going to soar and our deficit is going to be unsustainable. So no matter how you look at it, I think the glass is pretty much half empty here.
Well, you said just recently, just a week or so ago, you said Treasuries, no place to hide. Treasuries have absolutely no place to hide. They've, in May 3rd, and I know this, it was like about 1.63% for a 10-year yield money. Now it's, it was up to 2.75 or so, and now it's at 2.6 or so. It's up, 60% in about 2 months. It's still a cheap interest rate. But it's gone up astronomically in a short amount of time, has it not? Is that what you're talking about? Why Treasuries are no place to hide?
Well, the important thing is the Treasury is also obviously on the short end of the curve. There is no such thing as a safe asset anymore. I think that's the most important thing to realize. If you hold cash, first of all, the question is how you hold cash, but then the purchasing power of your cash is at risk. The Chinese have long diversified to baskets of currencies in order to mitigate the risk of any one currency. But clearly one of the trades that worked best over the last couple of decades is to buy Treasuries, while in recent weeks that hasn't worked so well. Now, some folks have been shorting Treasuries. Now, I don't know whether anybody of you listening to you does that. You've got to get the timing right when you short Treasuries. Obviously, in recent weeks, that's been very profitable, but it's very expensive to short Treasuries because you have to continuously supply interest. So what we do is we try to get out of the dollar. We buy gold, we buy other currencies, and we think we can stay a step ahead of the policymakers by assessing what they may be up to next and where the public thinks they might be going to next.
Well, I heard actually some people say that, everybody is wanting dollars because, it's the only place to go and hide. Well, I thought the economy was great and things were going wonderful. To your point, it's not going well. And I'm glad you brought up gold. It's been really hammered here lately, and there's all kinds of reports out now that it appears that where the price is, well, it's gone up here in the last few days, but that no mining companies are able to make monies, or few are able to have any kind of profit at the price of gold and silver, at around 1900 and gold at, 1250 or so. What do you think about the prognosis for gold, even with the Fed tapering that they say they're going to do sometime in the future?
Sure. Well, first of all, the reason why people buy the dollar is not because of quality. It's because of liquidity. The great thing about the U.S. is you can take your money out. That means you're not going to put your money into a country if you can't take it out in an instant. I like China, and I'd like to be able to take my money out in an instant, not in 3 months. And now, with regard to gold, the reason why we like gold is because there's too much debt in the world. The Europeans, and we can talk about Europe, they experiment with austerity, but the rest of the world prefers the printing press. The Japanese, the Brits, Americans. And so I don't know what gold is going to do tomorrow, but I do know that our deficits are not sustainable. And if you look at the political dynamics play out, we have the economy that's recovering very slowly, which means tax revenues are coming a little in higher than expected. At the same time, we have political gridlock. Well, I'm actually very optimistic we'll get entitlement reform to be on a sustainable path, but the motivation, the incentive to get there is what we have seen in Europe. The bond market has to force policymakers to get their act together. And unlike Europe, we have a current account deficit. So we'll be under far more pressure. At some point, the dollar will be under far more pressure, and that, of course, can lift the price of gold. The Japanese are probably going to set this example first. They may prevent the bond market from selling off too much. And so in that context, the Bank of Japan will step in, put a lid on the yield. And of course, there has to be a valve. The valve is the currency. Similarly, in the US, the dollar will ultimately be the currency. Of course, it's possible the dollar is going to continue to rally here. But mind you, even in a traditional environment, where we have an economic recovery, that's not necessarily dollar positive. And the reason is that historically, when the interest rates start moving up, the bond market turns into a bear market. Well, guess what? Foreigners that have to finance our deficits love buying treasuries. And when we're in a bear market, they don't like it so much anymore. Of late, central banks have been selling treasuries. And so all these things point to me that the dollar is going to weaken again, gold is going to resume its rise, but by all means, it's not a smooth ride. It's a rocky ride. You have to stomach the volatility, and gold, by the way, is more volatile than other currencies are, and so you've got to have a good stomach if you're going to pursue gold. But yes, I do like gold, and I have substantial gold personally as well, aside from investing in our funds.
What about the fear trade? There are a lot of people talking about, when I say fear trade, I mean fear of bail-ins. I mean, they have a pretty good framework in the European Union. That's what's being reported for the next banking crisis. There are several bank downgrades. Deutsche Bank has been downgraded. Barclays downgraded. Citigroup isn't doing so well either over here. We have some shaky banks. Couldn't we have some sort of interest rate spike, some sort of daisy chain of collapse of banks because of all these derivatives and all this debt that you're talking about globally? Are you worried about, I guess the short question, are you worried, and do you plan and do you try to hedge against some sort of systemic freeze-up or collapse?
I was very concerned in 2008. I took physical cash out, I took physical gold out, and I was very concerned about it. In the meantime, we do know the playbook of central banks. Remember, central banks can keep zombie banking systems alive. In Japan, we saw that play out very well. In Europe, by the way, a lot of banks are now better capitalized than U.S. banks are. And it depends a little bit on the metrics you look at. But the reason is because in the U.S. we have started to pay dividends again because we feel that we are so safe. Ultimately, we don't buy gold because of the fear trade, although we do watch these things very carefully. To the extent that we've bought the euro, we buy Northern European treasuries, and we've never bought anything in Southern Europe. But let me tell you something about Europe. In any crisis, initially there's a wholesale selling of everything, where there's the most liquidity. The euro was sold. Then the euro went up, but the spreads widened. And that's where it should happen, that the peripheral countries, the weaker Eurozone countries, should be paying more for their debt. But why should the euro suffer? Simply because we have a bank fail. In the US, we have bank failures all the time, but we don't have a currency crisis every time a bank fails. And the difference is we have a sound institutional process in place. Now, you can question, of course, some of the things about the FDIC, but compared to Europe, the processes are much better. And one thing that's happened in Europe is that, look at when there was the peak of the debacle in Cyprus. Well, a few days later, Spain had a treasury auction paying the lowest yield since the early 90s, which means the market has moved on, is able to differentiate. If you don't get your act together, they sell off your debt, but it doesn't mean the euro has to suffer as a result. And the banking system is far more robust than it has been. We know the playbook of the European Central Bank. And so that's one of the reasons we've had weakness in gold, because a lot of people are exiting the fear trade. I'm not saying that you shouldn't hold gold if you fear some of these scenarios happening. I'm just saying it is not the prevailing mood in the market right now. And it's one of the reasons we've had gold come back from its peak, because a lot of those fear trade buyers have been exiting, and the inflation buyers have not all joined that trade yet, are not all invested in gold at this stage.
So you think we're going from fear to inflation in the future?
Yes, I think the biggest threat we are facing is economic growth. Right now, of course, if you look at inflation expectations in the market, they have been coming down. And in fact, whenever inflation expectations in the US have come down as much in recent years as if they have now, the Fed has printed more money, not less money. And so we don't believe in the taper story that many others are talking about. And also, as far as and by the way, going back to the original theme of the strong dollar, well, we think that these opinions will converge. The Europeans are desperately trying to get a weaker euro. Draghi, the head of the European Central Bank, has been talking down the euro, but many people are not aware. The Europeans are mopping up liquidity, and that's because their central bank is more demand-driven. Banks are returning the loans they have received from the ECB. We continue to print money. And so it's all about talk and perception. And Bernanke doesn't like the 10-year where it is. He needs to talk it down. We'll see that in the near future, whether he's going to succeed. But the challenge Bernanke has is he wants to keep these rates low, so mortgage rates stay low. But if you look at this recovery, yes, home prices are coming up. They're still below the peak. But why are copper and lumber prices down? We do not have a housing recovery if those sort of things come down. We have a financial recovery. And similarly, the unemployment rate, yes, it's coming down, but we're creating more part-time employees and we're laying off full-time employees. That's because Obamacare is coming in and you don't have to offer health care for part-time employees. So I'm not disputing that there's some economic recovery, but it's not as strong as the Fed needs it to see. And that's why the Fed is not going to exit anytime soon. And with that, you'll have a convergence of opinions. And with that, we think the euro is going to be stronger, the dollar is going to be weaker. And I do think gold is going to get higher from here.
And so you don't believe the whole tapering. You think that's just a red flag. You think that's not a red herring. That you don't believe they're going to taper like they say they're going to pull this back. Because if they pull it back, don't we have a spike in interest rates? Isn't that counter to all the things they're trying to do? Hold interest rates down, keep mortgage prices, keep housing prices high, keep the recovery, quote unquote, going. If they taper it, doesn't that all fall out of bed?
Well, first of all, we are of the opinion that everybody's trying to do the best thing. So even the folks at the Fed, as critical as we are, they try to do the right thing. And they see the markets go through the roof, and they say, oh, my God, we have irrational exuberance. Now, Greenspan's talk in 96 didn't go over so well. And so they said, all right, let's at least talk about tapering. Let's at least talk about an exit. Now, all these economists at banks say, well, in the past, whenever we've talked about exit, we've hiked interest rates by this and this much within these many months, and immediately it's priced in. And because you've artificially kept these rates so low, everybody's jumping for the exit so fast. And it's mostly just a sign how difficult it is going to be to engineer this exit. And this has gone way too fast, way too far than any of these have liked. And so they have to pull back from now. And I believe in the best of cases, we'll have a very volatile Fed policy. The Fed wants to do the right thing, but they're taking too few baby steps. The market is going to throw a fit, and so they have to backpedal. And so with that, we're going to have substantial volatility going forward. The market is going to lose confidence in the Fed. And when you have more volatility in the markets, well, that's bad for economic growth. And by the way, it's not just bad in the U.S. We have the same thing, of course, internationally. Emerging markets have seen a flight of capital because our very, very small markets have gotten a lot of inflows. Everybody's running for the exit. So be prepared for more easy money to counter that. And with that, we'll have the same mess for many years to come. And yes, and we'll even get some economic cycles out of that. But it's going to be very frustrating for the Fed. And whatever investments you have, you've got to have a good stomach. But ultimately, if we allowed market forces to play out, I'd sell my gold. But because we have the Fed, and because I do not think Paul Volcker is going to succeed Bernanke, but more somebody like Janet Yellen, I do like my gold where I have it.
You would be buying gold right here in the 1200s. You'd be a buyer.
We have been buying of late in our funds, yes.
Axel Merk, he is the founder and portfolio manager of Merk Investments. I hope you come back. Thank you for joining us today on USAWatchdog.com.
My pleasure.